Happy Monday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Monday, December 19th, 2022. Starting with economic release spotlight. So this morning we got Q3 labor cost data out of the Eurozone, which I thought was surprisingly dovish, certainly relative to what has become a very healthy net long position on the euro in the futures and options markets. So that data decelerated 110 basis points to 2.9% on a year-over-year basis. That 110 basis point deceleration was the sharpest slowdown we've seen since March of last year, since Q1 of last year. And the 2.9% year over year is the lowest print we've seen since Q4 of last year. And by the way, that 2.9%, looking across the pond, compares to a 5.0% year over year employment cost index for the US economy and 6.6% 3-month annualized rate of change in private sector labor income here in the US, even adjusting for the kind of the weakness we're seeing in the household survey, the BLS report. So in our opinion, there's a real big disconnect in currency markets right now. If you look at money markets, expecting on a 1-year, 1-month forward overnight index swap basis, you're looking at 115 basis points of tightening over the next 12 months out of the ECB, yet those same markets are looking for 45 basis points of cuts out of the Fed. There is no world next year where the ECB is hiking interest rates and the Fed is cutting by that large of a margin. In our opinion, we think this wide dispersion represents a big risk for the euro heading into next year from these levels. So I just thought I'd share that. Skipping into my Lombo dashboard, starting with global macro. Bloomberg dollar index, that is short-term bearish, medium-term bearish, again towards the upper boundary of the range, not quite there. Gold bullish on both short-term and medium-term durations, right in the middle of the range. 10-year treasury yield bearish on both durations, right in the middle of the range. S&P 500, that's neutral on both durations now, right, getting towards the lower boundary of the range, right around 38.25. That's right around that JP Morgan, put collar exposure there. It's been provided some support for the markets. May have to wait until January to see some real significant fireworks on the other side, significantly below that level. Not making that call, just saying that's beware of that from a tactical trading standpoint. VIX, short-term neutral, medium-term bearish, right in the middle of the range there. NASDAQ neutral on both durations. Again, it's a very similar setup to the S&P, getting towards the lower bound of the range there. Might have some support anywhere around 38.50-ish on the S&P. I think it's 38.35 is that leg of the puts red collar. Russell 2000 bearish, short-term price momentum neutral, medium-term perspective, same thing with the S&P and NASDAQ towards the lower boundary of the range. Bitcoin neutral from a short-term signaling perspective, short-term momentum perspective, bearish, medium-term, same deal with Ethereum. Both are towards the lower boundary of their respective range, whereas Bitcoin in terms of the lower boundary of the range, 16,421 for Bitcoin. And where we at on Ethereum, right around 1,200, just a little bit shy of 1,200 for Ethereum there. So be aware of that if you're short crypto and the derivatives markets. Some interesting headlines this weekend. I want to say Binance's accounting firm basically kind of broke ranks with them on this sort of CZ has been basically saying, hey, look, we can meet customer redemptions. It's not an issue. Keep stress testing the system, And by and large, they're keep forgetting the name of this accounting firm, but their accounting firm was obviously on board with that up until this past weekend where there was crickets. So maybe in the most recent auditor review, they realized that maybe some of those statements might not hold water in a stress test scenario. So we shall see our crypto friends heading into next year. By the way, we're still very much in phase one of the liquidity cycle downturn. We haven't yet to even begin pricing in phase two, which is the credit risk portion of the bear market. That's a 2023 event in our opinion. Shanghai Composite bullish and from a short-term and medium-term perspective, middle of the range. WTI crude oil bearish from both perspective, also in the middle of the range. And then lastly, shifting to my free daily alpha tab, we got about 300 ETFs here, all representing individual factor exposures across global macro. Sorting them by the odds column, give you a sense of what's most overbought versus most oversold. Nothing overbought here this morning. What's most oversold? Finland, QQD, DB hedge strategy, global natural resources. So a lot of investors, so the natural resources is really puking here. This is either this confirmation of the China reopening. So I would say narrative around China reopening. We all discussed the China reopening in terms of our views on that last week. I want to say on Friday and in the macro minute on Friday. So definitely go check that out. But certainly just confirming a lot of what you would expect to see from that perspective. So maybe a clue there. I'm trying to see if there's anything else that doesn't really stick out. Yeah, no, not a particularly actionable day That'd be the only thing I'd really call out in the context of everything we've been talking about in the program. So with that, Darius Dale presenting our macro minute for Monday, December 19th, 2022. Best of luck out there this week, and happy holidays. I think it's the beginning of Hanukkah or something. So happy holidays to our Jewish friends and everyone. Happy holidays to everybody. This is it's a wonderful time of year, and we appreciate being able to go through what has been a crazy topsy-turvy year all through all the ups and downs and wiggles and wins and losses thereabouts. We're just, we appreciate having an audience to share some of these views with you. So thank you. Catch you back here tomorrow. Cheers.